Now, you might be thinking that, wow, that sounds kind of scary that I could buy a corporate bond and the corporation could go out of business. What would then happen? Well, believe it or not, if a corporation files for bankruptcy, many times the bondholders actually get a significant amount of their money back. It could be anywhere from 50, 60% of the value of the bond or more. Even investors that owned Enron, a company that went bankrupt in the early 2000s, got back, I believe, about 50 cents on the dollar of the bonds that they own.
Are you ready for a successful retirement? We're addressing the topics facing today's retirees. Welcome to Retire with Ryan. Now here's your host, Ryan Morrissey.
Welcome back, everyone. I've been getting some recent questions from clients about what to do with money that they have in checking or savings that's not paying anything, and also some questions from clients about what to do with bonds that they have that are maturing. So I figured this episode would be a good time to talk about bonds, get into some of the basics of bonds, and talk about some of the bond strategies that you can use for your money. So first of all, what is a bond? Well, a bond is basically an IOU between you and whoever you're lending the money to. And that could be a bank if you're keeping your money in a CD, a money market account, or it could be a corporation if you're buying a corporate bond. It could be a municipality if you're buying a municipal bond, or it could be a government if you're buying a government bond. And for that loan, you're giving that person you're lending your money to access to your principal, and they then control your principal for a certain time frame, and they pay you a rate of interest on your principal during that time. So let's say if it's a 1-year CD, you're giving your money to the bank for 1 year. They agree to pay you maybe 1% interest, and at the end of that term, you then can get your money back, and you can do something else with it, or you can renew it for another term. And bonds really have 3 different types that you could buy, and I mentioned them earlier. There are corporate bonds, U.S. government bonds, and municipal bonds, and I'll talk a little bit more about those now. So corporate bonds are bonds that where you're buying a bond issued by a corporation like Apple or Microsoft, and you're lending your money to that corporation. There's a set term as far as how long you're lending them the money. So if you buy a 5-year bond with Apple, then for 5 years, Apple has control of your principal, and over those 5 years, they agree to pay you interest. And most corporate bonds pay interest on a semi-annual basis. So twice a year, they'll pay you interest. And at the end of the 5 years, the corporation is supposed to pay you your principal back, your initial investment. But during that time, if you want to get out of your bond before then, something happens, you need access to that money, there's a bond market similar to the stock market where you can go and you can sell your bond. Now, most corporate bonds trade in values of $1,000. So that would be what you initially bought the bond for. And during the time frame between when you buy it and when it matures, when the term ends 5 years later, the price will fluctuate anywhere from above $1,000 to below $1,000, depending on what's going on. If Apple's having potential issues, if the company's having issues that you own the bond in, then maybe the price of the bond will be down. Or if they're doing better or interest rates happen to go down in the meantime, then the price of the bond could actually go up. But if you hold the bond until when it matures, whatever that time frame is, in our example here, 5 years, you'll get back your initial $1,000 as long as the company pays you back. Now, corporate bonds generally pay the highest interest because they carry more risk than the next 2 options of bonds. And most corporate bonds are just backed by the ability of that company to generate income. So it's backed by the revenue the company makes. And if they have any issues paying, then you don't have anything else backing the bond. So therefore, it's really important that you understand the risk involved anytime you're buying a corporate bond. And to help you understand that risk, most companies that issue bonds pay money to be rated by one of several rating agencies that exist. A few of these are Standard & Poor's and Moody's, and these companies look over the financials of a corporation, look over how much money they owe, how much leverage they're using, and assign a letter grade. The highest being AAA and the lowest rating being D. Anything that is BBB or higher is considered an investment grade bond and carries a medium risk of that corporation not paying you the interest they promised or giving you your principal back on time. When you go below BBB, now you're getting into what's known as non-investment grade, also sometimes called junk bonds or high yield bonds. So if you stick with investment grade bonds, the risk of default, meaning of you not getting paid your interest or principal back on time, is relatively low. You can be rewarded by buying bonds that have a lower rating, that it would be considered a junk bond or non-investment grade, but you have to really understand the potential risks involved with that and weigh that out as you're making decisions about how to construct your portfolio. You could also end up losing money or seeing more fluctuation in your portfolio by owning high yield bonds. Now, you might be thinking that, wow, that sounds kind of scary that I could buy a corporate bond and the corporation could go out of business. What would then happen? Well, believe it or not, if a corporation files for bankruptcy, many times the bondholders actually get a significant amount of their money back. It could be anywhere from 50, 60% of the value of the bond or more. Even investors that owned Enron, a company that went bankrupt in the early 2000s, got back, I believe, about 50 cents on the dollar of the bonds that they own. Now, there are situations where the bonds can be wiped out as well, but they do carry more safety than owning a stock of a company, whereas in a bankruptcy, most stocks usually become worthless immediately. Now, as I mentioned before, you're going to get the highest yield generally with corporate bonds, but if you're looking for a slightly more conservative route, and also if you're potentially in a higher tax bracket and this money that you're investing is money that's outside of your retirement accounts, then you might want to look towards municipal bonds. Now, municipal bonds are issued by state governments, local municipalities. They come in one of two varieties. They come in either revenue bonds or general obligation bonds. General obligation bonds are backed by the ability of that municipality to collect tax revenue. So these are perceived to be a safer investment of the two because of the ability of a municipality to simply raise its taxes, right? Unfortunately, any municipality, any state or local government can always decide to tax its residents. They can decide to tax their residents more. Now, the residents can decide to move, and that's the way you can get out of not paying. But because of that, these are considered to be safer. Whereas revenue bonds are backed by specific projects. So they might be backed by tolls or hospitals or schools, other projects that are bringing in revenue. So those carry more risk than a general obligation bond, because if that project isn't managed properly, then there's the potential of investors either not getting back their money on time or not getting paid their interest on time, or potentially completely defaulting. And a lot of municipalities also choose to have their bonds underwritten. And again, municipalities pay for this just like corporations do, either using Standard & Poor's or Moody's. And the third company, which I didn't mention earlier, is Fitch. And just like with corporate bonds, you can also deal just with investment grade municipal bonds, anything BBB or higher, or you can buy non-investment grade municipal bonds that can pay higher interest, or some smaller municipalities also just doesn't make sense for them financially to have their bonds rated. So there are quite a few municipal bonds that are not rated at all. Doesn't mean they're good or bad. It just means that they're not rated. And you really need to understand what you're doing and do your homework if you're going to buy those. Now, obviously, you can look across the US, and there are quite a number of states that are in financial difficulty. So you want to be careful with buying municipal bonds. Also, if you're going to buy them with local municipalities, same thing. You'd want to understand how the residents of that local municipality are doing financially. Are they paying their taxes? Are there any major corporations that have maybe left the area that is going to put a strain on the tax base in that area? And some municipalities also choose to get insurance, similar to SIPC insurance, where if the municipality has an issue, then the insurance will pay out the investors, pay out the interest, or pay out the principal. So this is an added layer of safety that you can seek, but generally these bonds that carry this insurance will pay less interest than ones that don't. So the question is, why would you buy a municipal bond over a corporate bond? Obviously, they possibly could be safer if one had a higher rating than the other, but the real reason is the tax savings. So with municipal bonds, if you buy them in the state that you live in, you don't pay state tax and federal tax. Now, municipal bonds are always federally tax-free, but if you buy them from a state that's not your resident state, then you would not pay federal income tax, but then you would pay state income tax. So the real benefit there is the potential tax-free income to you. Also, if there's a local tax, if you happen to live in the city or a city where there's a city tax, then that could be exempt as well. Also, bonds issued by Puerto Rico, no matter what state you live in, are exempt from federal tax, state tax, and any local tax, sometimes known as triple tax-free. To determine if you should buy a municipal bond instead of a corporate bond, you first need to determine the tax that you would pay on income from a corporate bond. Let's just say, for example, you could buy a 4% corporate bond, and this was money outside of your retirement account, and you paid between state and federal taxes 25%. So 25% of your return went away, so that would leave you 3% after tax. So that's your after-tax return, 3%. Now you could then go and look to the municipal market and see, could you buy a similar bond that's paying you 3% or higher interest? And if you could, then you'd want to buy the municipal bond because you're going to be making more money on it. But if you weren't able to do that, let's say you could only find a bond paying you 2% interest, then you'd be better off buying the corporate bond and paying the tax because even after taxes, your return is higher. So that's one of the ways that you can look at, does it make sense to buy a municipal bond? Probably for most people today, you have to be in the highest federal tax bracket. Many times for it to make sense for you to own municipal bonds, you could be better off with a portfolio of corporate bonds and paying taxes. So next on our list of bonds are buying U.S. Treasury bonds, and otherwise known as U.S. government bonds. So these are considered the safest investment that you can buy, presumably in the world, because as you've probably heard, many other countries end up buying U.S. Treasury bonds to put their own money in. An example is China. China owns a very large amount of U.S. Treasuries. And these come in 3 different varieties: bills, notes, and bonds. Bills are 1 year maturity or less. Notes are 1 to 10 year maturity, and bonds are 10 years or more. And these go all the way up to a 30-year U.S. Treasury bond. And the interest on these, unfortunately, is relatively low because these are such a safe investment. The U.S. government doesn't have to pay a lot of interest for them. And many times when you're looking at evaluating risk, the measure that's used generally is the 10-year U.S. Treasury. As I'm recording this today, the 10-year U.S. Treasury is at 0.79%. So if you were to invest your money into a 10-year U.S. government bond, you'd get a little bit less than 0.8% per year for owning that bond. Now, U.S. Treasury bonds are exempt from any state tax or local tax, but they are, however, subject to federal tax. So if you wanted to be a very conservative investor, U.S. Treasuries could make sense for you. Or if you thought things were about to get very bad in our economy, then U.S. Treasuries could be a good place for you to park your money. You'll often see, if you follow the financial news, that a lot of times when the stock market's going down, you'll see that the price of U.S. Treasuries are going up because investors are buying more U.S. Treasuries to get out of the stock market. There are also U.S. savings bonds, Series EE bonds or Series I bonds. These are not marketable, meaning you can't sell them in the secondary market. Once you buy them, you have to redeem them back to the Treasury. You're allowed to buy up to $10,000 per Social Security number per year. And these are another way to invest in U.S. government bonds. There's another option for a U.S. government type bond that's not a direct obligation, and that is there's a few U.S. agencies out there that you can buy bonds from. These agencies are Ginnie Mae, Fannie Mae, Federal Home Loan Banks, Federal Farm Credit Banks, and the Tennessee Valley Authority. You can generally get higher interest on these than you can through traditional treasuries, but they carry some additional risks. So as far as investing in these bonds, you have some different options. One way is that you could open up a brokerage account with a discount broker, such as who I use, TD Ameritrade or Fidelity, Charles Schwab, and you could buy these bonds individually right from the broker. You can buy them either as new issue bonds where you're paying whatever the original issue amount is, let's say $1,000 or $5,000, and you could then hold them to maturity, and then when they mature, you could then reinvest them. You can also buy bonds that have already been issued. Let's say a bond was already issued for $1,000, and you can now buy it. If it was a 5-year bond, it had a 5-year maturity, and you buy it 2 years after, you could buy it and hold it for the remaining 3 years. Or another option is that you can also buy a mutual fund. You can let the mutual fund decide which bonds to buy for you. Let's say you were going to buy a corporate bond fund. You could leave it up to the bond fund to buy the different corporate bonds that were appropriate for you. And if you're going to buy mutual funds that are going to own bonds, you really need to understand what the strategy of that fund is. Let's say it was a corporate bond fund that you were buying. You'd want to understand what quality of corporate bonds they are buying. Are they buying investment grade, non-investment grade? And are they buying, US-based corporate bonds or foreign-based? Or what maturity? Are they buying short-term, intermediate, long-term? So you really want to understand all these factors. So there's, just like with the stock market, there are a number of risks that come with bonds. So one risk is interest rate risk. Bonds and interest rates have what's known as an inverse relationship. That means if interest rates go up, that will cause the price of bonds to go down. And if interest rates go down, that will cause the price of bonds to go up. So as I'm writing this, we're at a very low point in interest rates, and we've come from a much higher point. So that's been very good for bonds. But going forward, as interest rates are increased, this will be negative to people that own intermediate to long-term bonds. So you want to be aware of that. And if you're buying individual bonds or bond funds at this point, you probably want to stick more towards intermediate or short-term bonds. The next bond risk we're going to highlight is inflation risk. So inflation can be measured in different ways. A lot of times in the US, it's measured by the Consumer Price Index. And historically, bonds have just about tracked inflation. So bonds are not a very good hedge against inflation. They'll generally just keep pace with inflation. That's where you want to own more growth-oriented investments, either stocks or real estate. The bonds are really more the portion that's going to just preserve what you have. There's also default risk, and that's the risk that your bond could lose value or whoever you're lending the money to doesn't have the ability to pay you back on time. And that's where you want to understand what the risk of that is. With U.S. government bonds, that risk is relatively low. With many municipal bonds, also that risk is also probably on the lower end. But you want to make sure that you understand that. And if your bond is rated, that you understand that rating as well. Some of the strategies to help maximize your return on your bonds that are out there, one is called laddering. This is where you buy bonds that have different maturities. So let's say that you had money that you wanted to invest in U.S. Treasury bonds and you thought interest rates were going up. Well, you could buy 5 different maturities. So you could buy a U.S. Treasury that matures 1 year from now, one that matures 2 years from now, 3 years from now, 4 years from now, and 5 years from now. So if interest rates are going up, then your 1 year maturity bond will mature, and then hopefully if rates have gone up, you can reinvest that at a higher rate. So you're going to benefit from rates going up. That strategy doesn't really work when rates are going down. Another strategy is referred to as the barbell strategy. If you think of a barbell, you've got heavy weights on each end. So in that scenario, you'd split your money between short-term and intermediate to long-term. So you'd maybe have half of your money in short-term and the other half in long-term, so that if rates did go higher, then you have your short-term money and you could reinvest that at a higher rate. And if rates didn't go higher, then you still had some of your money earning a higher yield in the meantime. So if you're going to be investing in bonds, just make sure that you understand the risks and match the portfolio of bonds up with the risks that you're comfortable with. Or if you're uncomfortable buying individual bonds, another good option is to use a mutual fund. So I hope this was helpful on educating you on the different bonds that are out there and possibly putting some of the excess cash you might have into something that could earn more interest to you. As a reminder, my retirement readiness workshops are going on right now. There's still a series of workshops that are starting next week that you can sign up for. And you can find out more about that by going to retirewithryan.com or morrisseywealthmanagement.com. Thanks for listening. Talk to you next week. Take care.
You should consult a financial advisor familiar with your specific circumstances before you make any financial decisions. Nothing in this broadcast constitutes a solicitation for the sale or purchase of any securities. Any mention of rates of return are historical or hypothetical in nature and are not a guarantee of future returns. Ryan Morrissey, CFP, is an investment advisor representative of Morrissey Wealth Management, LLC, a registered investment advisor.